And as we have been reporting this afternoon, just a few minutes ago, the Treasury Department auctioned a record $15 billion worth of 30-year notes. How did it go? With that and an outlook on the current environment for interest rates, we are joined by Carl Lantz, who is the interest rate strategist at Credit Suisse. Welcome, Carl.
Happy to be here.
All right, so what's your take on today's 30-year auction? Who showed up and what were they willing to pay after yesterday's relatively weaker 10-year auction?
Oh, I think the auction went very well. I mean, it came very close to market levels. We had a bit of a concession going in. I think people were happy with the price they got at the auction. Indirect bids were very strong at 44%, which is above the historical average. So that all suggests that there's plenty of demand for treasuries as an asset class.
It's interesting now, though. So what does it all mean now that the Fed has laid out its plan to stop buying government debt? You're saying there's still demand out there.
Actually, I think it makes a lot of participants more comfortable. The Treasury purchase plan, was very small in size relative to the size of the outstanding bond market or the amount of supply this year. $300 billion is really a drop in the bucket. So it didn't do a whole lot in terms of providing liquidity to the market. If anything, it raised some fears about debt monetization and future inflation. Those fears, I think, were probably overdone. But at the end of the day, the end of the program, I don't think is a problem, and I think it'll actually make some people more comfortable owning the long end with the Fed printing less money, as it were.
Generally speaking, then, do you expect interest rates to come down?
We do. We think we're going to grind lower in yields over the next couple months. The big action will probably be in Q4, and we're looking for 10-year yields to actually fall a little below 3% by the end of the year.
Okay, so then what should we look for in terms of leading indicators that the Fed will need to change its rate policy? Because at some point, they're going to need to start tightening.
That's right, but I think it is some way off. Employment is definitely key. Historically, the Fed starts tightening or easing after the labor market turns decidedly. So, it probably won't be until unemployment crests. And, apart from that, you've got the inflation story, which we think is going to be very benign, which gives the Fed the luxury of time, because we think prices will actually be very muted, and we're going to see core CPI come off a lot in the months to come.
So we've got, of course, a very normal, steep yield curve portending economic recovery right now. What will the yield curve look like come the end of the year?
It'll be flatter, not tremendously so, but given our expectation of 10-year yields rallying quite a bit, we could have a 2s-10s curve that is less than 200 basis points, potentially 175 to 200. But that'll still be steep in a historic context.